Hello, and welcome to the March 2025 Market Update webinar. My name is Dan White, one of ARK's associate portfolio managers, and I will be moderating today's call. This call was pre-recorded on March 14th, 2025. Typically, in this next section, we hand it over to ARK CEO and CIO Cathie Wood for high-level market and macro commentaries. However, that ties directly with the first question today, so we are going to dive right into the Q&A portion. Questions were received from distribution partners, submitted via saytechnologies.com, and sent to our Funds X account at ARK-Funds. So, Cathie, the first question. Based on recent market downturns and recession fears, what is your outlook for the rest of 2025 and beyond?
Yes, and I always reference our In the Know webinar that we do on Employment Fridays. So I go into much more detail there. But to summarize, we do believe we are entering some negative quarters here for real GDP. And the way we give that perspective is we've been saying for quite some time, we're in a rolling recession, which started with housing in 2022 and has followed through to most sectors with the exception of consumer, mostly high-end consumer, and the government sector. Well, the rolling recession is now hitting those two sectors as well. So we believe that the downturn is going to give the Trump administration and the Fed many degrees of freedom now. We think that inflation will be much lower than expected. We already see the long bond market discounting lower real growth and inflation. So the market agrees with with the outlook I've just described. And therefore, we do believe the Fed will be cutting rates more this year than many people now expect. So I actually think it's going to be a very good year for the financial markets, again, because of the degrees of freedom that the Fed and the administration will have. I know that the tariffs are a source of great concern, both from an inflation point of view and a recession point of view. Tariffs are regressive taxes if they make it through to pricing. We think that they won't make it through to pricing in the environment that we're seeing. And in fact, we believe that China, just as it did the last time around, will devalue. It is going through a deflation in consumer prices, and so it can afford to devalue. And that means the purchasing power of our dollars go up when it comes to Chinese goods. I think the other very important thing that we're learning from this administration is that it's not going to make the same mistake that the Reagan administration made, which was phasing in tax cuts over a multi-year period. In fact, we're hearing that this administration, when it does cut taxes, will want to do so either retroactively to January 20th, the inauguration day, or as of the date of the legislation, which is very good. And finally, on taxes, and I do think this is why the market's going to do very well this year. We hear a lot about the tax cuts or tax-free tips, overtime, and Social Security. That is a certain demographic that does not include the wealthy, which from a political point of view is a very good setup. But we do think that, and this is just reading between the lines, Kevin Hassett at the NEC seems to be suggesting that tax rates will come down more broadly. We'll end up with a flatter tax. That also would be very positive for the financial markets. So we know that the market's been very rough here. It's felt a little chaotic, especially given the way tariffs are slapped on and then pulled off, and given all the geopolitical risks. But we think that from an economic point of view, that we're moving into a period that this rolling recession is going to come to an end at some point this year, and will end up in a very strong productivity-driven expansion, where the real growth rate could surprise significantly on the high side of expectations, thanks to all the new technologies that we talk about all the time: robotics, energy storage, artificial intelligence, blockchain technology, and multiomic sequencing. So those 5 major innovation platforms involve 15 different technologies, which are converging. And as you all know, we spend all of our time from a research point of view and investing point of view trying to figure out how those new technologies are going to evolve and scale in the years ahead. So we're pretty excited.
Thank you, Cathie. And for our listeners, we mentioned it on the last call, but please take a look at our Big Ideas 2025 for an in-depth analysis and forecast on those different technologies Cathie's mentioned. For our next question, we received a lot of questions on Tesla. And so trying to boil this into one here, team, what will it take for Tesla's stock to rebound in the short term? What long-term impacts, if any, will Elon's political divisiveness have on the company?
Yeah, I can start this out. I think that the key here, well, there are 2 keys to Tesla's performance during the next year. One is the lower cost car that Elon has announced for some time in the next few months. And so he has often said that there is not a demand problem for Tesla. It's a pricing problem. Now, clearly, the political dynamics of the last few months are hitting demand. We also would suggest that the economic outlook is hitting demand, not just for Tesla, but for all auto manufacturers. So it'll be difficult to discern how much of the demand hit is due to a political kind of attack and how much is economic. But we do believe the resolution is going to be in lower prices and well below the average cost of a gas-powered vehicle. And ultimately, and I'll leave this to Sam and Tasha, ultimately robo-taxis, which catapults Tesla into a SaaS-like stock with the kinds of margins that SaaS, software as a service companies, enjoy. So maybe I'll hand it over to Sam on the EV front and Tasha on the autonomous front to take us through some more of the thoughts we have.
Sure. Thanks, Cathie. On the EV front, right now, the biggest question is, what impact does this slowdown in EV sales have on our modeling? And so for context, we do look 5 years out, and in that 5-year out projection, just human-driven electric vehicles, which I think is going to be increasingly important to denote that, is just 9% of enterprise value. And so certainly in the near term, and we've seen this reflected in the stock price, lower human-driven EV sales, that's what everyone is focused on. But really, the upcoming catalyst that's Elon has mentioned on the past earnings call is the launch of Robotaxi in Austin. And so, Tasha, I'll pass it to you to talk about that opportunity and why we're so excited about Tesla over the medium term here.
Yeah, thanks, Sam. So as Sam mentioned, over roughly 90% of the enterprise value that we think will be attributable to Tesla is from the robotaxi network over the next 5 years, and this year is really the pivotal year. They say that they're launching in Austin in June, so it's possible they could launch in Texas, maybe California as well by the end of the year. And as Cathie mentioned, this business will completely transform the business model. Waymo proved that this model is possible, that an autonomous car is possible. We're seeing great signs from the consumer versions of full self-driving, and note that the version 13 of the software suite is actually the version that they'll launch on for full autonomy. With Tesla's already delighting drivers in terms of the amount of times that they, in some cases barely have to touch the wheel, right? So I think that we're seeing progress on the way there. Looking forward to that June launch, and I think that that'll be a really important moment for everyone to realize that, okay, robotaxis are actually here, and this is possible, and that this business transition is happening. So we think that the margins from the robotaxi business could well exceed 50%. It could be 80% plus margins, depending on the pricing that Tesla's able to get. But of course, ride hail in the U.S. at $2 to $2.50 per mile provides a really nice umbrella for Tesla to charge. And we see Waymo charging equivalent pricing to humans. We think Tesla has a superior cost structure. We talked about that in our Big Ideas presentation. So they could significantly lower prices, which should drive additional demand for ride hail.
And another question we get around Tesla quite a bit is how can Elon be focused on Tesla if he's spending every day in Washington on DOGE, the Department of Government Efficiency? We've gotten to know Elon's modus operandi over the years, and it's very clear that he has surrounded himself by the most talented engineers and business people who are attracted to his companies because he's solving some of the most difficult problems in the world. And we do think that that autonomous taxi networks that represents the biggest AI project in the world. And Elon himself is focused on any bottleneck, anything that is hampering progress or slowing Tesla down. That is how he's always managed the company. And he's laser focused and maniacal in terms of rooting out any bottlenecks and other obstacles to progress. And we think he's behaving in the same way with Tesla right now. We're almost there with robotaxis. We can all feel it as we're in our own Teslas and seeing how miraculously FSD is now even parking, and all of the obstacles that seemed to be in the way before are disappearing one by one. The other thing we do say about Elon is he, probably more than any other executive in the country or world, understands that AI projects, the key to success is proprietary data. And just think about all of the proprietary data he has access to, not in the government, I'm not suggesting that at all, but in all of his companies. And we think that the progress in all of his companies will be AI driven, and the proprietary data that he has is, I think, going to be one of the surprises in terms of the kinds of products and services he's going to be developing in the years ahead.
And then, Cathie, one of the other Tesla questions we often get is, how do you manage such a volatile name in the portfolio?
Yes, we do post our trades every day, so we get a lot of publicity for are tactical moves, and they are purely tactical. For example, when Tesla was reaching for $500, we were taking profits. In fact, I think we sold roughly 400 basis points of Tesla. And then when it was almost cut in half, we redeployed some of that cash into Tesla. So it never left the top position in the flagship portfolio. But you're right, Sam. It's very volatile, and we do trade around, and we do generate alpha by trading around the volatility associated with various names in the portfolio.
Thank you, team. I have one more question still staying on Tesla here. So we touched on sort of the data moat and the proprietary advantage they have, the pricing, which attracts consumer, and then the final leg here on that, consumers utilizing this end is just safety. I know the team's done a lot of work on that. Tasha, do you have any updates for us?
Sure. So, and this is in our Big Ideas presentation as well. So the last data point that we have on the safety of full self-driving was that a Tesla vehicle that uses full self-driving is actually 5 times safer than one that's driving in manual mode. When you look at the national average statistics, so there's roughly a crash every 700,000 miles in the US. Tesla believes that they'll surpass that this year. Of course, that's an important milestone for robotaxi. Note that we think that robotaxis will launch with human operators. This is what Waymo and others have done. So while the system may not be perfect, there could be remote operators that will help in emergency situations. And to Cathie's point on data, one thing that should give regulators confidence here is that, we estimate that Tesla is able to have access to over 10 million miles of data in full self-driving alone versus, say, just 100,000 roughly that Waymo has access to. So, a much larger data pool here to look at those corner cases and really to statistically prove that you're safer than a human.
Yeah, and I think in Big Ideas you'll see how we somewhat precisely predict when a Tesla car will be safer than a human-driven car, and it's I think in the fourth quarter of this year when a Tesla car will have an accident or a critical intervention, I think we call it, Tasha, every 700,000 miles or more. So.
Great. Thank you, Tasha, Sam, and of course, Cathie. Changing gears here from Tesla to our next question on crypto. So Lorenzo, the question is, are we at the beginning of a cryptocurrency bear market?
Thanks, Dan. So I will start saying that we do not believe we're at the beginning of a cryptocurrency bear market. I think to put this into perspective, I just want to remember that, in early September, Bitcoin was at $55,000 more or less, to put it into perspective. And so now the price is at 84, well over 50% of the September prices. And typically in bull markets, we do see 30 to 35% drawdowns, several of them during bull markets. So this is not something unusual at all. I would add, I think the question was on cryptocurrency, and obviously I do believe this year, more than others, Bitcoin has been really in a league of its own and very separate to the rest of the cryptocurrencies that we have. And I will just touch on perhaps Ethereum and Solana, which are the two biggest ones after Bitcoin. Ethereum has been, underperforming Bitcoin for the past year. I think there are, some questions around governance and value accrual. We do believe fundamentals are getting, stronger with stable coins, tokenized assets, and other verticals. Solana, on the other hand, has outperformed Bitcoin for most of last year. But, this month in March, there are proceeding of the FTX bankruptcy that are getting that have been auctioned off last year that are getting distributed to investors, and we do think that that puts some some short term pressure on Solana in general. I think if we look at the overall stablecoin market, and I think the question really goes there, we have seen a lot of the gains in the last 8 months. I would say 8 to 10 months, basically disappear. Like prices have gone back to prices where of a year ago, and I think we're just seeing a lot more tokens being launched, and so we do think there is going to be some consolidation this year. Um, we think a lot of the names are actually getting more attractive on a fundamentals basis. If you look at price to revenue, price to sales, a lot of these protocols are getting to 100 million, 200 million, 300 million of annual revenue, and we think there are going to be more of those protocols. So we definitely think the market is going to consolidate. We have many more tokens than we had in past cycles. I think just to touch on for 2025, the setup, I think, regulatory wise, has never been this good. We've had, obviously, the administration signed the executive order for the Bitcoin Strategic Reserve and the crypto asset stockpile. We have had the OCC, allow banks now to hold cryptocurrencies and stake them. We have two bills that are now going through Senate for stablecoins to delineate basically federal and state share on stablecoins. And we do. I think the setup in terms of regulation has never been better, frankly. So we do not think we're in a bear market. We do think that Bitcoin is really in a league of its own right now, and especially in terms of institutional flows. And for the rest of the market, there is going to be some consolidation, but we think assets are going to have a great year in terms of prices.
Yeah, Lorenzo, if I'm not mistaken, there are now, are there millions of tokens being created with AI agents part of the reason?
Yeah. I mean, Cathie, you're right. I think obviously with AI automating a lot of the infrastructure, there are now hundreds of thousands of tokens being launched every day. These are obviously not all serious, crypto projects by any mean, but we have orders of magnitude more crypto assets than in past cycles, for example.
Great. Thank you, Lorenzo. The next one, we're going to move over to the multi-omics world with Nemo here. We've seen the team, the questions on Recursion, we've seen the team buying shares through this market volatility recently. So Nemo, could you please provide us an update on your thoughts around Recursion?
Absolutely. I'm always happy to chat about Recursion. So how we think about Recursion is really that Recursion is defining the future of the drug discovery today. So 2024 has been a pivotal year, marking the first time Recursion has shared clinical efficacy data. REX 617, a potential best-in-class CDK4/7 inhibitor, showed early signals of efficacy even before moving into combination therapy, with one patient experiencing sustained tumor reduction for over 6 months. REC 994, targeting cerebral cavernous malformation, demonstrated both robust safety and promising signs of functional improvement. These are clear proof points that Recursion's platform is working. But beyond these kind of clinical milestones, Recursion is also operating at scale that few, if any, can actually match. With one of the most advanced supercomputers in biopharma, BioHive 2, and multimodal data platform, generating over 1 million transcripts in just a year, and about 2 petabytes of data weekly, Recursion is not just collecting data, it's leveraging it to fundamentally reshape the drug discovery. Strategic partnerships continue to validate this model. So Roche and Sanofi milestones alone generated 45 million in cash payments in 2024, proving that the Recursion platform isn't theoretical, it's delivering tangible value. And even more importantly, Roche and Sanofi deals are totaling to $12 billion if the Recursion delivers everything on their end. That's the biggest ever partnership in AI drug discovery done. And then with 600 million in cash runway extending to 2027, the company is well positioned to execute on its ambitious roadmap. The integration with XAI has only accelerated this progress. In just 3 months, Recursion has already seen a 60% reduction in human time to hit to lead initiation and 2.5-fold increase in efficiency for identifying bioactive compounds. The merger is proving that many had hoped. AI-driven discovery is not just faster, it's actually fundamentally better. Looking ahead, Recursion is building something even more powerful, a virtual cell. By integrating AI models across atoms, proteins, pathways, and real patient data, Recursion is moving toward a future where biology can be simulated before experiments have even begun. This shift will redefine the industry's approach to discovery, optimization, and clinical validation. So, Recursion is no longer proving that tech bio works, it's proving that it is the future. Faster drug discovery, lower costs, and higher success rates aren't aspirational goals, they are actually happening at the moment. And as 2025 unfolds, we can expect even more proof points to reinforce Recursion's leadership in this space.
Thank you, Nemo. I'm hearing it's a great convergence story of both artificial intelligence and multi-omics here.
And automation.
And automation, robotics.
Recursion is the Tesla of multi-omics. Mark my words.
Thank you, Nemo. We look forward to learning more about Recursion in the upcoming updates as well. Moving into space here, Sam, what kinds of progress do you see in the space exploration industry evolving over the next few years?
Yeah, I think it's a continued trend. And what SpaceX did originally, they paved the way for reusable rockets. And what are we going to see in the next 2 years is rapidly reusable rockets. And this is significant because that's going to continue to drive this cost decline, allowing more things to be launched into space, and those impact things happening in orbit as well as on the ground. And hopefully within the next 2 years, some starships will be heading to Mars as well. So a lot of exciting things going on there. That's very SpaceX focused. Within the next 2 years or so, we should also see some reusability attempts from other companies. So Rocket Lab hoping to reuse. You have others, Stoke Space. You've got Blue Origin as well, who made it to orbit hoping to reuse. But really, as all of these companies are trying to achieve reusability, I think the next leg is that rapid reusability.
Great. Thank you, Sam. We're going to come back to multi-omics, and this one's for you, Cathie, more high level here. Compared to the other ARK funds, the ARKG ETF has not seen quite the same recovery as the other ones since the 2021-2022 drawdown. What are some of the main factors that have held this fund back, and what might drive that recovery?
I think that's an understatement, Dan, in terms of the performance relative to the other funds. And in fact, in ARKK, our flagship, it's taken a lot of work to keep the multi-omics position in the low 20% range. And why are we doing this? Well, first of all, let's explain why this is, if you take out the boom bust around COVID, this is an 11-year base. And as we all know, bases evolve in the equity market. If you have any technical understanding, bases evolve, and there's either a breakout or a breakdown. 11-year bases, that's very unusual. And we do think that's the rubber band stretching and that there will be a breakout. What has hurt ARKG relative to the other funds is it is the theme, it's the earliest stage theme in an innovation set of innovation platforms or convergence of innovation platforms. And therefore, these companies are sacrificing short-term profitability. Many of them have been moving towards cash flow positive territory. And I believe the entire portfolio has 4.5 years roughly of cash runway. because the market has forced that kind of consideration by all of these companies. And so cash flow negative or barely cash flow positive, that has been something the market has not liked in the kind of interest rate environment we've been in. I think the other consideration is around campaign season, which was last year. There's always talk in the healthcare space about getting pricing down. Now, that shouldn't hurt our names that much. They're completely new therapies, and in fact, some of the cures are getting reimbursed to the tune of $2 and $3 million. And insurance companies have no problem with that because these new cures are saving the healthcare system so much in terms of sick care dollars. So that should not, but it does cast a pall over the entire space. And then the third variable we've been confronting is, again, a wholesale shift in Washington. And people are just afraid of what that will mean for healthcare. I think here again, though, we think it will play to the benefit of our companies if Robert Kennedy is really focused on getting rid of chronic diseases. Cures are certainly a big part of that. And so we think our technologies and the convergence among sequencing technologies, artificial intelligence, and new technologies like CRISPR, gene editing, and other gene therapies are going to be a part of the solution that this new administration is seeking. And if we do reduce the sick care dollars by curing disease, there's going to be a lot more room for these breakthrough cures and a lot more reimbursement potential.
And maybe if I can add, just Cathie, I think we are really in this pivotal time in the healthcare system where there is this paradigm shift between the sick care, which is a chronic disease management, to our actual healthcare. Our portfolio is designed to actually to kind of support this paradigm shift. And we are not, we are thinking really in the future. And for example, so we are trying to kind of see where the future going and then help build not one subsector of the healthcare, but actually the whole ecosystem. And so, for example, we are very exposed in gene editing companies such as CRISPR, Prime, and Beam. But we understand really well, if we can't diagnose those patients and actually identify them correctly, and that's why you have a strong exposure in diagnostic companies, we can't actually do the treatment the best. And then we also understand that these diagnostic companies are not going to be delivering the tools, the tests, without companies such as Illumina, Twist, 10x Genomics, which are actually enabling the tools. So we are taking one comprehensive approach to kind of really build healthcare ecosystem versus today's sick care, chronic disease management that exists.
Yes, and Nemo, you called Recursion the Tesla of this space. I think we have a lot of Teslas. Tempus would be in that category as well. And I'll also say, in terms of conviction levels, I remember when Tesla was going through production hell and many analysts were predicting bankruptcy. Our conviction actually was going up during that time, and we loaded up on Tesla, which benefited our clients significantly. I feel the same conviction in this space now. The stars are aligning, including the political dynamics out there, to benefit our space. And, while autonomous vehicles, robotaxis, that might be the largest AI project in the world in terms of revenue generating potential during the next 5 years, healthcare is the most profound application of AI and other technologies. I've never seen an 11-year base like this, but I do believe that it is the rubber band stretching as more and more analysts start doing work on companies that are generating revenue today from cures, and really start understanding how much more valuable a cure will be than traditional therapies. And you can find our thoughts on that in Big Ideas 2025. We think the returns on R&D in this space are going to go back to the golden years, the late 80s and 90s, when the biotech revolution really kicked off with Genentech. We think we're in another healthcare revolution today, and the returns, which have dropped all the way down to 3-4%, are going to turn around and enter a period where we will see 30%, 40% returns once again.
Yeah, Cathie, and I think that's one of the really unique things about ARK's research and so important to the process here is that starting first principles allows us to come to these conclusions, and that's what guides the research, is that top-down research, the bottom-up conviction in individual names, sizing that opportunity and viewing it's very unique compared to the sell side. And so if we are directionally correct, they will have to do a lot of updates to catch up. And that's where you have that unique mispricing in the portfolio. That's so important to our process. The next one here, we're going to jump to the next gen team with Frank. So Frank, how does the UAE's rapid AI adoption and 5G infrastructure affect your tech growth projections, if at all?
Yeah, I'll take this in maybe two parts. One is that we think AI adoption is going to proliferate across the world, and you see the US and US based tech companies as kind of the first movers in generative AI in particular, led by OpenAI. You also see China now increasingly competing, and there are other regions that want to have their own in-nation AI talent, and the UAE and Middle Eastern nations broadly are one of those buckets that's investing quite rapidly. And maybe the most interesting thing for this region in particular is that they're willing to take risks on investing in some of these earlier stage semiconductor companies that are seeking to compete with the US-based companies like NVIDIA and AMD. So two examples, one related directly to the UAE is Cerebras, which is in their IPO process right now, which has both an investor and a significant customer in G42, which is based out of Abu Dhabi. And then from the broader Middle East region, we have from Saudi Arabia a contract of $1.5 billion to invest in Grok's, Grok with a Q, not with a K, inference infrastructure to run AI models. And this is actually a company that we recently invested in the ARK Venture Fund. And so this region in particular seems apt and willing to take risk on these newer architectures, risks that maybe the US hyperscalers aren't ready to take yet, and could fund some of their initial growth and initial generations so that they can compete on a broader scale over time with some of the US incumbents. The latter half of the question on 5G infrastructure, this isn't something we focus too broadly on in our research. The terrestrial telecom networks are not a blocker for our technologies to scale and ramp, but there is another space, literally space, that we're interested in, which is the satellite telecommunications networks, really led by SpaceX's Starlink, that we do think is very important and possibly a disruptor for these terrestrial networks.
Great. Thank you, Frank. With that, we will conclude our webinar today. Thank you to everyone who listened to today's call, and thank you to the entire ARK team.